Your money app says you have $1,000. But that number could represent three very different things: a deposit your bank owes you, a payment stablecoin an issuer promises to redeem, or a tokenized deposit that is still a bank liability running on new technology. To you, each one may look like the same balance on a screen. To the financial system, they are not the same money. And that difference explains a quiet fight now taking place underneath banking, stablecoins, and instant payments. The prize is not simply the button you press to pay. It is the balance that remains after you close the app. Because the institution that holds that balance can control the customer relationship, gain a source of funding or reserve income, and influence the rail your money uses next. So before asking which app is fastest, ask a more important question: who actually owes you the money? Start with an ordinary bank deposit. When your checking account shows $1,000, there's not a sealed envelope with your name on it, sitting inside the Federal Reserve. The balance is a liability of your commercial bank. In plain English, the bank owes you that money. On the other side of the bank's balance sheet are assets such as loans, securities, and reserve balances. The exact mix varies, but the essential relationship does not. Your deposit is the bank's promise to pay you. Now imagine sending money to someone at another bank. Your app shows the instruction. The banks update their customer records. Behind those screens, the institutions settle with one another using central bank money, including reserve balances held at the Fed. That gives us three separate layers: the interface you see, the financial claim you hold, and the settlement money institutions use between themselves. A fintech can control the first layer without holding the second. A payment network can move the instruction without becoming the institution that owes your balance. Once those layers are separated, the fight over deposits becomes easier to see. Consider three products that can all be marketed as digital dollars. The first is the familiar bank deposit. The bank is the obligor. The balance sits inside the banking framework, with bank supervision and deposit insurance rules applying where the account is eligible. The second is a payment stablecoin. Here the holder normally has a redemption claim on the issuer, supported by a reserve portfolio. That is not automatically the same legal claim as a bank deposit. The distinction is becoming more explicit. An FDIC proposal released in April would require covered payment stablecoin issuers to maintain identifiable reserve assets and generally redeem coins within 2 business days. It would also say that bank deposits held as stablecoin reserves do not give stablecoin holders pass-through FDIC insurance. That is a proposal, not a final rule. But it reveals the central issue. The reserve may sit at a bank while the consumer's claim is still against the stablecoin issuer. The third product is a tokenized deposit. Despite the word tokenized, it remains a commercial bank liability. The record-keeping and transfer technology may change, but the bank still owes the depositor. So the important label is not simply digital, it is bank, issuer, or some other legal obligor standing behind the balance. Now the Fed is considering a change at the settlement layer. On May 20th, the Federal Reserve proposed a new limited-purpose payment account. Legally eligible institutions could use it specifically to clear and settle payments. That sentence needs 2 large asterisks. First, the proposal does not expand legal eligibility. It does not mean every fintech or stablecoin company can suddenly open an account at the Fed. Second, this would not be a normal full-service master account. A payment account would pay no interest. It would provide no intraday credit and no access to the discount window. Payment services would include automated controls designed to prevent overdrafts. Those limits are the point. The proposal tries to give certain eligible institutions a narrower path to clearing and settlement, without also giving them the full package of central bank credit and support available to traditional banks. Supporters can argue that more direct settlement may reduce cost and delay for new payment models. Critics can ask whether institutions outside the traditional bank supervisory structure have strong enough safeguards. The Fed's public comment period closed on July 27th, and the proposal remains pending. Nothing has been granted yet, but the gate is being redesigned, and everyone wants to know who may eventually stand closer to it. At the same time, payment speed is increasing. FedNow recorded just under 5 million settled customer credit transfers in the second quarter of 2026. That was 83.2% more than in the first quarter, with an aggregate value of roughly $274.7 billion. Those are large growth numbers. But they do not prove that deposits are leaving banks. FedNow is a payment rail used through participating financial institutions. It can move an instruction and complete settlement faster, while the underlying customer balance remains a bank deposit. In fact, domestic deposits at FDIC insured institutions grew 2.1% in the first quarter of 2026, their seventh consecutive quarterly increase. So this is not evidence of a system-wide bank run into stablecoins. It is a strategic competition over where balances may live as the rails underneath them improve. That creates several possible winners. Banks can keep the deposit relationship and place those same liabilities on tokenized or more programmable rails. Stablecoin issuers can win distribution and the economics of assets held in reserve when users choose to hold an issuer claim. Fintech firms can win the interface and payment experience even when customer funds remain at a partner bank. And the future may not be a simple contest between banks and blockchains. In May, the BIS reported that Project Agorá had delivered a prototype combining tokenized commercial bank deposits with tokenized central bank reserves on a shared platform. The prototype demonstrated atomic, multi-currency wholesale settlement. It is not a live retail network, but it shows why banks may adopt tokenization rather than surrender the balance itself. For consumers, the lesson is not that one form is always better. It is that identical dollar signs can hide different rights, protections, and redemption paths. When you see a balance, ask 4 questions. Who owes it? What backs it? What protections apply? And how does it reach final settlement? The quiet war is not really over the payment button. It is over the balance that remains after you close the app. Follow that balance, and you can see who actually controls the next version of money.